Hello, today we are solving May 2025 IAL Unit 2 question number 6. This is about the statement of cash flow for Red Jupiter Media PLC and it has been drawn up according to IAS 7 and is shown below. So here the statement of cash flow for the Red Jupiter Media PLC for the year ended 31st March 2025 is given here. Adira has been given a copy of the statement of cash flow for Jupiter Red Jupiter Media PLC for the year ended 31st March 2025. She is thinking of investing in this company and she is seeing this statement, but she requires some more information. So first part of the question here, it says customers owed 76,000 pounds at the start of the year. Calculate the amount the customers owed at the end of the year. Here we are thinking of receivables. Okay, the receivables, there has been a decrease in trade receivables. So whatever, okay, there has been a decrease in trade receivables. Okay, so whatever is the changes, okay, in the trade receivables for 2025, it is always found by using this formula, closing balance minus the opening balance. So if here there has been a decrease in the trade receivables, if there is a decrease, you take this value as negative. Okay, so that is equal to minus 28,000. That value had been, there has been a decrease. Okay, when you were calculating the closing balance minus opening balance. So you don't know the closing balance, or we have to find, this is what the calculated, the amount owed at the end of the year. Okay, that is the closing balance, and they owe at the beginning of the year, opening balance, or the customers owed 76,000 pounds. That is the opening balance you will include. So closing minus opening balance. So that is going to be equal to, okay, this is the value here. So now the closing balance, okay, closing balance will become equal to, okay, I am going to take 76,000 on the other side. So 76,000 pounds, okay, minus 28,000 pounds. Okay, 28,000 pounds, which was a decrease in trade receivables. So that is going to be equal to, okay, so that is going to be equal to 76,000 minus 28,000. So the value is going to be equal to 48,000. So the amount, okay, the amount the customers owed at the end of the year will be equal to 48,000, and that was the closing balance. Okay, closing balance of would have been the closing balance of the trade receivables. Okay, and the changes, okay, or the changes in the trade receivables from the big opening and closing, okay, which you have calculated, it was equal to 28,000 and there was a decrease. Okay, so when you are calculating closing minus opening balance, if you get a negative balance, you will declare it as decrease in the balance. Okay, and if it was a positive, you will include it as a positive balance. You will say it was an increase in trade receivables that has happened from the closing minus opening balances. Then suppliers were owed 39,000 at the end of the year. Calculate the amount suppliers owed at the start of the year. Again, here you are trying to analyze what is the changes in the balances from the beginning, okay, opening and closing. So the formula remains the same. It is a closing minus opening balance. So the changes in the balance has been declared as increase in trade receivables. Okay, the increase in trade payables. So the increase in trade payables was around 19,000. Okay, so you will take it as a positive value. Okay, that's all you have to do. If it was a decrease, you will take it as a negative value as we had done in the previous, okay, which was the difference between the closing and opening. But here it is an increase, so you will take it as a positive balance, okay, which is equal to 19,000 minus closing balance minus the opening balance. Okay, so here what do we know of the end of the year? So we know about the closing balance, it was 39,000. So here we will replace, that is going to be equal to, okay, this value this value. So I will replace with 39,000, okay, pounds, which is a closing balance, okay, and then I will calculate what is the opening balance. So opening balance will become equal to, I am going to take it to the other side, and I am going to have 39,000 on this side of the equation minus, okay, minus 19,000. So that is going to be equal to 20,000. So that is going to be equal to 20,000 pounds. Okay, so this is the amount the suppliers owed at the start of the year. So the beginning balance, okay, or the opening balance of trade payables is the same, which is equal to 20,000 pounds. Okay. Then state two reasons why Red Jupiter Media PLC would sell a tangible non-current asset. Tangible non-current asset is one with the monetary value. Asset with the monetary value is a tangible asset. For example, I can state that it could be it could be a equipment, okay, or something like that. So example, equipment. Okay, it could be an equipment which has a monetary value. Now why do they want to sell? So they would sell if equipment was not working, had become obsolete or worn out. Okay, it is working no more and I want a new equipment for the office, okay, to be utilized, or I need cash for business. Okay, either you need a new equipment, okay, you need a new equipment, okay, as old equipment, okay, had become obsolete, or it had got worn out, or it had got damaged, or I need cash for the business. Okay, those are the two reasons when I would sell my tangible non-current asset. One item of equivalent equipment was the only non-current asset sold. Calculate the book value of this equipment. Now we can see here, okay, so there was a sale, okay, the sale of the non-current asset, okay, when they sold, the cash they received, we have to write, okay, the cash they received was equal to 39,000 pounds. So they have given that amount, okay, what was the value they received, plus was there a loss or a profit, okay, we have to see. If there was a loss, it means they have sold less than the book value. If there was a profit, they have sold more than the book value. So because there was a loss, okay, 13,000 pounds. So the value was 13,000 pounds they had sold for a loss, okay. So if any loss, then book value, okay, book value will be less, okay, the money received or the cash, okay, cash received will be less than the book value, will be very less than the book value. So that is equal to the loss, okay, that incurs in the business. So from this formula I can write that, okay, loss incurred was equal to the book value must have been more, okay, the book value must have been more than the cash received, okay. So the loss was around 13,000. We don't know the book value, we have to calculate, minus the cash received was 39,000 pounds. So book value will be equal to 39,000, okay. When I take it to the other side, it will become 13,000, okay, 13,000 plus this value, okay, it will become positive when I take to the other side of the equation. So that is going to be equal to 39,000 plus 13,000, that is equal to 52,000 pounds. Okay, so you should also know, what if there was a profit stated here, there was a profit on disposal. Okay, then in that case you should know that, okay, if it was a profit, okay, if it was a profit, then profit is equal to, okay, if profit, the cash received was greater than the book value, which means profit would have been, okay, which is greater, you will write it on the other side. So it will be cash received minus the book value. Okay, so this is how you will calculate the profit. If there was a profit listed, the book value is calculated using this formula. Okay, the cash received minus the book value would give you the profit. You have received greater cash, but if you received less than the cash, the difference is called as the loss, and using this formula you will calculate here. So that is the thing. Next one is, explain why an adjustment for depreciation charge is added in the statement of cash flow. Here we can see that, okay, you are adding depreciation of non-current assets and sale of non-current asset and interest. Okay, these are actually the depreciation and the loss, notional loss, which they are non-cash items. It's notional, it's actual, not cash lost in the business, or depreciation doesn't indicate there has been a expense in the business. These are non-cash items, okay, non-cash expenses. You don't need to, and they have been already subtracted from the profit, okay, when you are taking this profit, okay, which you had calculated from the operation after the interest, already includes, okay, it has already subtracted, interest has already subtracted, it has subtracted non-cash expenses. It has already subtracted non-cash expenses, okay, such as depreciation. And depreciation doesn't indicate cash expense. It is not a cash expense, but you have already subtracted it. So to get the profit, we add back depreciation expense, okay, expense in cash flow statement, okay. So you will add back the depreciation expense in the cash flow statement, okay, to profit, and okay, and calculate working capital changes to get cash from operations. Why do you want to do all this? I want to get what was the cash generated from the operations. So to get to that point, I need a profit where I have to start up from a point where the profit I have not I need a profit where I have not removed depreciations, okay, I have not removed certain expenses. I need to start off from that point, because this has already been subtracted. When it is not, it is not going to affect the cash, right? Depreciation expense is not going to affect any cash, so I don't want to include in the calculation. So you will have to remove any depreciation expense which you had subtracted from the profit, and you will use the profit to calculate the working capital changes to get the cash generated from operations. So I don't want to include this depreciation expense, which is a non-cash expense and it doesn't affect any cash movements, okay. Depreciation doesn't indicate cash expense and will not affect cash. Okay, cash flow. It is not affecting any cash flow. There is no actual cash flow that's happening in the business. Okay, so I will have to, you had included, you had already subtracted profit from operations, has already subtracted this non-cash expenses such as depreciation. Okay, and depreciation will not indicate a cash expense and it is not going to affect the cash flow. So to get back to the profit, we add back depreciation expense, okay, in the cash flow statement and get profit. Okay, to get profit, and then you calculate working capital changes. Okay, you will make adjustments, make adjustments for working capital changes to get the cash from the operations. So that's why I need to add back the depreciation, which is not going to affect the cash flow. Explain one difference between a cash statement of cash flow and a cash budget. Statement of cash flow is a financial statement that includes, okay, it is a financial statement, is an actual, okay, it is a financial statement that includes actual cash flow figures for the year. Okay, what is the cash movements that has taken place? Cash flow, actual cash flow movements or the changes, cash flow changes or cash flow figures, okay, included for the year. Whereas this cash budget includes estimated figures. Okay, it will be cash budget includes estimated cash flow figures for future. Okay, it doesn't include the real one, it includes the estimated figures. Okay, and also the statement of cash flow, it's a compulsory statement to be prepared for investors. Cash flow statement is a compulsory statement for investors. It is a compulsory financial statement used by investors, prepared for investors. Whereas cash budget is not a compulsory statement prepared for the investors. It's not a compulsory statement. Okay. You need not compulsorily prepare, but you have to compulsorily prepare the cash flow statement. Okay.